Hello everyone and welcome to today's major markets update for Friday, August 19th, 2022. The expected pullback is clearly underway, so let's have a look at the charts. Again, no real surprises. We knew this pullback would eventually happen. It was simply a matter of when exact levels. So we had those levels, we broke higher, then we got the next levels, we broke higher, then we got the third level, and from there this now more significant pullback is underway. I still view it as only a wave 4 within a larger impulse, preferably. And I'll also show you why, based on some new BREF study data that I have found and want to share with you. Never forget Jesse Livermore's 21 trading rules. Stick to them, learn them, and remember, nobody can be right all the time. Nobody can know exactly what's going on in a very dynamic, stochastic, probabilistic environment. So I always say I'm about 70% of the time correct. If you think that's worthless or not good enough, please go to Las Vegas and you will have a 49% chance. And somehow people preferably go to Las Vegas with a 49% reliability than the stock market. So here you have your coach, your trainer, and your mentor all at the same time. If that's not enough, always remember there's a lot more to it than just these updates. Use them to your advantage. If you don't, it's your loss, not mine. So please, if you have always problems, get in touch with me. That said, let's go to the charts and then we'll do the summary. I'm starting off with the Dow Jones. Dow Jones can still do this micro 4-5 setup. It wouldn't surprise me. I'm leaving it on the chart. If we start to see continued further weakness, then I'll update the chart accordingly, and that wave 3C has already topped. So far, we've only done 3 waves lower. We had our top here on Tuesday, Wednesday lower, Thursday a little bounce, Friday lower, so that is still a simple ABC. Very simple. That doesn't mean the correction is over, but after 3 waves lower, expect at least 3 waves back up, either as a very small 4th wave and then a 5th wave, so you get an impulse, or as a flat, so you get a 3-3-5 with 3 waves back up, larger 3 waves, or we get a triangle, a 3-3-3. So please always keep that in mind. That's the beauty of Elliott Wave. We know what's going to come. We just have to let the market decide which is going to be. So far, a little bit of a fake breakout above the 200-day moving average, but otherwise things are moving along quite nicely. Let's look at the NASDAQ100. NASDAQ100 has already reached the lower end of the ideal wave 4 target zone. Perfect. So technically, we've done enough to complete this wave 4. Let's have a look at wave 2. This was 1, 2, 3, 4 trading days. This one has so far also been 4 trading days. So from a time symmetry perspective, we have done enough. From a price perspective, we have also done enough. It's really possible. My preference is for a little bit longer, more drawn out correction, because that's typical what 4th waves are, especially since this correction here in late June was fast and furious. So we might expect more of a sideways, longer drawn consolidation, a sort of a flat type of correction, wave A, wave B, wave C. I'll show you that in a minute using the S&P 500 hourly chart. But the daily chart is chugging along nicely. Look, we had a nice 5-1 relationship here at this week's high, right into the adjusted ideal C/3 target zone, already back at the ideal 4 question mark target zone, and eventually we should get this wave 5. If we start breaking below 12,800, expect this red path. If we don't, we hold the target zone, we hold about 12,900, expect the green path going forward. So here is the hourly S&P 500 chart. I had penciled in here this wave A target zone, and then a bounce for wave B, and then another wave C. So far, so good. The reason I have it as a zigzag is because the wave 2 here was a flat. I still prefer to see it as a wave 4-5 setup. I don't have, of course, enough information, and I know where I'm wrong, and that is if we go below 4,090. I really don't want to see it go below 4,090. That increases the odds we're going to 3,900. And that will, in my humble opinion, be too much of a pullback for wave 4. Then I will label it again as an A, a B, and a C. So we've reached the A target zone. I expect a bounce soon, either Monday or Tuesday. Most of the time we do get follow through on Mondays when Fridays are sell-offs. So maybe a little bit lower into this ideal target zone, then the bounce, and then the next leg lower to complete this wave 4 into this ideal target zone. The target zone here is anywhere between, I would say, 41.10 to 41.85, potentially only 41.50, 41.85. Okay, but we have nice confluence here of the usual 23.6 to 38.2% retrace, 41.85, 40.95, of a CSA relationship between 41.50, 41.85, and of course the Fibonacci levels of the internals for this rally between 138.2 and 123.6. So I think we'll get there. So far, no surprises. We topped, and then I'll just leave the internal smaller time frame scribbles for what they are. The smaller the time frame, the less predictable things get anyway. So this again looks like 5 waves lower here since this B wave high. So we'll let this all figure out, but I think we'll bottom here in this zone in gray up to this gray zone down there. Perfect. So that brings me then to the bullish wave count, and that is that we have 1, 2, 3, 4, 5. Again, the market breadth starts to suggest more and more that this is the case, but we haven't seen this. I need to see 5 waves up in green, and then I'll be, I wouldn't say fully on board with this one, because wave 1 can still be wave A, but then the next pullback will be the low risk buying opportunity. After 5 waves higher, expect 3 waves down, and another 5 waves higher at the minimum for a 535 type of correction, but most likely we'll see then this impulse. So please keep that in mind. We should now be this wave 4, target zone, getting close already, and then wave 5, target zone, drop, rally. That's the preferred path. Even this wave A, again, can reach to about 43.70, as this could be a 4th wave pullback within a 5 wave A. IWM tracking along nicely as well. Look, we've already gotten close to the ideal wave 4, either in green or in red, doesn't really matter at this point. Target zone, which is anywhere between 195 and 190, so we're getting there already. So far, still only 3 waves lower. Looks good. I see no reason to change this chart. The only chart that's still a little bit ambiguous is that for the semiconductors, lots of ups and downs, but I'll stick to the ABC setup here. Again, if we get a breakout above 3100, then we are already in this wave 3C. A breakdown below Wednesday's low targets again 2800 plus minus 50. Nothing out of the ordinary. Very clear if then scenarios. Breakdown, we go here. Breakout, we go there. It's a little hard to know exactly because we're pretty much back to where we were late July. So if we have a non-trending market, there is no direction. It's hard to know exactly where it's going to go till we see breakouts or breakdowns. Let's have a look at the new lows for today. The data will certainly be updated later today, but so far nothing too benign. We're not really in the hundreds or thousands. It's at the low 40s and in the 80s for the NASDAQ100. So nothing yet too crazy. Can always change, but it doesn't look too bad for now. The PMO buy all, sell all indicator has still not given a sell signal, meaning that we're dropping below this ideal sell zone. It could give it today. The data has not been updated yet. Wouldn't surprise me. But please remember the setup that we're currently experiencing is quite similar here on the left-hand side of your screen of the April, May, June pattern 2020. So please keep that in mind. Yes, past performance is no guarantee for future results, but we've been overbought without any pullback on this indicator for quite a while. So that starts to really resemble these type of strong uptrends, which would fit with the 4-5 scenario, because this is where we were for the S&P 500 as well. 1, 2, 3, 4, 5. So it matches. To be determined, but again, no sell signal yet, maybe today, and then we'll see what comes out of that. Maybe we go back to a buy signal again, like we saw in May of that year. Put call ratio a little bit lower, looks a little bit more toppy, but nothing that screams sell, sell, sell just yet. If I then go and look at the percent of stocks above their 50-day simple moving average, as I shared with you yesterday as a prelude to today's update, I can see it went over 92.5. Okay, actually 92. When that happens, since 2002, that's the only data set I have available, we never went back into a bear market. Okay, So we already got the breadth thrust where we went from below 2.5 to over 20 to tell us that we're most likely in a new bull market, which were these black lines here, black line, black line, black line, black line, most likely here black line as well. There were only 1, 2, 3 setups where we made a marginally lower low and then the new bull started. And there were 2 setups where the low was already in place and the rally continued. So all of them eventually resolved themselves bullishly. So far, we've not seen a pullback since that from below 2.5 to over 20 setup, which suggests that we are in these occasions where the market might continue to rally with only smaller pullbacks that would fit the 3, 4, 5 scenario that I'm tracking. Now, if we then add the fact that we're also above 90, then we have to look at what happens when we rally above 90 on this breadth indicator, meaning more than 90% of all the stocks in the S&P 500 are above their 50-day simple moving average. That by itself is already, of course, a bullish data point. So then we have these blue dots, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. This has happened 13 times over the last 20 years. Reasonably frequent, but not too common. It's about once a year. None of these signals, meaning we're going over 92, happened during a bear market. It happened in 2003, it happened in 2009, it happened in 2010, 11, here in 12, 13, 16, 19, and in 20 and 21. Bull market, 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 bull market. Yes, we got the pullback here in 2010, but of course we're long-term bull market, bull market, bull market. That's the outcome of this. I know past performance, no guarantee for future results. If we are super cycle 4, maybe none of this data matters anymore because we are in a totally different regime that we've never experienced before, so this data falls apart. But I'd rather go with history than with kind of making up this type of excuse and trade what I see in front of me, and that is this. Yes, there will most of the time be small pullbacks, as you can see. Why? Because we've gotten so overbought. We cannot continue to have more and more stocks going over their 50-day moving average, right? The ceiling is 100%. So then we need to back off, which we're doing currently in this potential wave 4 and then a 5 setup. Ultimately, intermediate to long term, this is a bullish signal. Then we had a new all-time high on S&P 500's advancing declining issue percent line. It went above the early 2022 high. So what does that tell us? Is that bullish or bearish? Let's have a look. I shared this chart with you before already. I only have data since 2010. Maybe there's more data available. I haven't found it yet. And I looked what happened to the markets every time it made a new all-time high. That was here 2011. Then it was here 15, etc. So you can see we had several occasions where we have a dotted line, a red line, and then a blue line, where the market first made a significant new lower low and then rallied, except here 2020. So in black is the AD line, and you can see here in about June, July of 2020, the S&P 500's AD line made a new all-time high. Okay, so the market rallied and continued. Same here in 2019. However, here in 2018, we did make a new all-time high on the AD line, but then we got a drop and then the rally, which is of course the second breakout. Same here in 2015-16, we made a slight new all-time high in the AD line. We almost bested the all-time highs, by the way, here in the fall of 2015. But then we got the C wave lower because this was a flat, an ABC, and then eventually we got the true breakout. Okay, so this path is still possible. And then, of course, 2011, same deal. We got the counter trend rally in A, B, and C. This was also, by the way, a large, expanded, irregular flat. You can really see here, if you follow my cursor, in early 2010, we topped for wave 1, I believe it was, of this major one of primary 3. And you can see 3 waves lower, 3 waves up, and then 1, 2, 3, 4, 5 waves lower. So that is a expanded irregular flat, 3, 3, 5. So the B wave gave the false trigger, and then the C wave did the trick, so to say, that we got a big crash and then higher. ultimately every single thing resolved itself higher, of course, because what you get is, of course, higher breadth readings. So it is still possible that we're going to see lower prices according to this indicator, but it also tells us to expect higher prices eventually. Now, last but not least, here is a tweet by Urban Carmel about the NYMO. It is the McLennan oscillator for the NYSE. And if you make a summation of it, meaning you add today's reading to that of yesterday, which was added to that of the day before, you get what we call a summation index. The MO measures simply the difference between advancing and declining, and of course also issues that don't change at all during the day. And if that MO is positive, it means you have more stocks advancing. If it's negative, you have more stocks declining. Well, yesterday, I believe it was, this NYSI pushed to 860. And according to Urban Carmel, I mean, that's at least his stage name, so to say, I don't know his real name, that happened only during the beginning of bull markets. Yes, there might be corrections along the way before we move higher. Not necessarily, but it might. These are more type of consolidation paths, just as we saw for the AD line. We have such a strong market breadth reading that we need to maybe step off the gas. We cannot continue to rally these stock prices. We need to take a breather. Ultimately, this always happened in bull markets, never in bear markets. So, great, I did it myself. I looked at the data. The only reading that came close is 854 here, 2001, because this is what Urban Carmel points out in that it went over 60, higher than the field rally in February 2001. So if we look at all the data available since 1998, that was the only reading. So we're higher than that one already. And you can see, bottom line, in bear markets, the NYSI never reaches above 854. Never. Not in 2000 here, in 2001 between 2003, not in 8 and 9, not here in 2010, not in 2011, not in 2015, not in 2019. Every single time we get a reading over 860, it's not part of a bear market. So this also suggests this is not part of a new counter trend rally, but part of a new bull market. We have historical data that points out 9 of 10 out of 10 times. We have 1, 2, 3, 4, 5, 6 times. 10 out of 10 or 6 out of 6. So every single time we go over 854, 860, it's not a bear market rally anymore. It's a bull market. So this starts to suggest that the bullish wave count that I shared with you is most likely operable. Okay, but as I told you as well, if we are in a super cycle 4, if it is possible, then maybe none of these historical studies are relevant because we have not experienced anything before it. But again, I'm not going to bet on something that I am assuming. I'm going to bet on what the data tells me. And also this, again, adds weight to the evidence that we are seeing these breadth thrusts and breadth readings that are too high to tell us that we are going to crash like in 2008, 2009. I've seen this comparison over and over again, and those fractals with now versus 2008, 2007. And remember, the market is indeed fractal in nature. It's self-similar because, of course, the Elliott wave that unfold, but that doesn't mean it has to resolve every single time the same. Quite often not. That's the whole point of fractals. They keep having the same pattern, but then the outcome changes. That's why you get a fractal type of pattern. Otherwise, pretty much everything becomes linear if everything resolves itself all the time the same. It would be too easy as well. We all know now that 2008 is going to repeat itself at 2007. So get ready, short the crap out of it, and everybody will be rich. But that's not how the market works. The market works by wrong footing the most. So bears will be bears, and just look at the patterns and say, yeah, we're going to crash. I've seen these comparisons with 1929 every single time. But we need to add all these different layers of evidence to tell us, is that really going to happen? According to this chart, 100% no, not going to happen. Couldn't care less on how good your Elliott wave is. And honestly, I find it amateuristic to only look at price charts and say, see, we have this fractal. Great, but please add context to it. And this is the context you provide. I provide and you won't find anywhere else. I haven't found anybody that does Elliott Wave and such insights on market graph reading as me. So there, I patted myself on the shoulder. And with that, I want to say this is all I have for today. There's really not much else to add to my analysis. Quick summary, the pullback is underway. We anticipated it. Started off from a little bit higher than originally anticipated, but that's fine. We monitor it and we adjust. Now we let the market decide if it wants to morph into something more significant of a pullback, but in my humble opinion, initial signs tell me this won't. Meaning that on Wednesday, I was already looking for a reversal below today's low. On Wednesday's low, we target 41.80, 42.25, and we got it. We reached 42.19. So I think that's wave A of 4. We should get a bounce early next week for wave B of 4, and then a wave C to complete this wave 4. That's my preferred view, unless we break below 4,090, 95-ish. Then we target 3,900. Below that, I think we're going to head to new lows. I still, of course, have to let the market be the final arbiter and not any of these analyses that I just showed you. But again, the market breadth studies that I now shared with you, in addition to everything else I've shared with you before, suggest more and more that we are in a bull market. However, again, if this is a super cycle 4, then none of this historical data matters because we've never seen a super cycle 4 in this historical data. So then it's not relevant. But I do prefer to go with the historical data. And if this NYSE study is of any relevance, it shows us there is no more major bear market like 2001, 2, and 3, or 2007 and 8, because we never get such strong graph readings in bear markets. I know the data set is limited, but that's all we can go by. That doesn't mean just buy everything that we can get our hands on. We still have to see this 4-5 sequence. When I see this 4-5 sequence, you'll be the first to know. I think then it's really, really time to put on more firmly the bullish hat, because right now we still need to let the market decide if that's going to happen. But you already knew that, so we are diligently waiting for this 4-5. I have my target zones. So far, the correction is unfolding exactly as anticipated. No surprises. With that, have a great weekend. Take care, trade safe, and I'll see you all on Monday with a regular email. Take care. Bye.